Everyone thinks investing is complicated. Charts, candlesticks, RSI, support levels, macroeconomics, Fed rates, earnings calls. You open a finance YouTube channel and in 30 seconds you feel like you need a PhD just to not lose your money. Here's what nobody tells you. That's not investing. That's trading. And trading is genuinely hard. Most people who do it professionally still lose to a basic index fund. Investing is embarrassingly simple. And I'm going to prove it to you in the next 5 minutes. Let's kill the confusion right now. Trading is trying to predict what a stock will do next week, next month. You're looking at charts, reading signals, timing entries and exits. You're basically playing poker against people who do this 80 hours a week. Good luck. Investing is completely different. You're not betting on price movements. You're buying a piece of a real business and betting that in 10 years, that business will be worth a lot more than it is today. One of these requires a Bloomberg terminal and the emotional stability of a Buddhist monk. The other one requires a brain, some patience, and maybe 30 minutes a month. So how do you pick a company worth investing in? Forget the balance sheet for a second. Start with one simple observation. Find a company that is already selling something to tens of thousands, maybe hundreds of thousands of people. Not a prototype, not a pitch deck, not a concept. A real product with real customers that people are actually paying for right now. That last part is crucial because a company with a concept is a lottery ticket. A company with a product and paying customers is a business, and businesses are what you invest in. Now ask yourself, what happens when this company doesn't serve 100,000 people but 10 million? Is that realistic in the next 10 to 20 years? If the answer is yes, you're looking at something interesting. There's a term for what I just described. Scalable proof of concept. Proof of concept means the model works. People want the product, they buy it, the company makes money. Scalable means it can grow without falling apart. Think about it this way. A restaurant can have proof of concept. Great food, full tables every night. But can it serve 1 million people? No, without a completely different model. That's not scalable. Now think about a software company. They build the product once. Selling it to one person costs roughly the same as selling it to 1 million people. That's scalable.
The question you're always asking is, as this company gets bigger, does it get more profitable or does it just get more complicated and expensive? The answer to that is called economies of scale. And it basically means the more you produce, the cheaper each unit gets to make. If a company has that going for it, growth compounds. Okay, you found the company. You believe in it. You understand what they do and how they make money. Now, do not take your life savings and throw it in all at once. And yes, I know you've heard don't invest what you can't afford to lose. You know that already. I'm not here to repeat it. What I am here to tell you is the actual mechanic that removes the anxiety of timing. It's called dollar cost averaging, DCA. Simple idea. You invest a fixed amount every single month regardless of price. $100, $500, whatever makes sense for you. The price is up, you buy. The price is down, you buy more units for the same money. You never have to ask, is now a good time to buy? Because the answer is always yes. You're buying anyway. Do this consistently for 10 years, and the math works in your favor almost regardless of what happens in between. One rule that is non-negotiable, you have to deeply understand the company you're investing in. Not surface level. Not, oh, I've heard of them. I mean, you can explain in plain English what they sell, who they sell it to, how they make money, what their competitive advantage is, and why someone wouldn't just switch to a competitor tomorrow. My advice, invest in something you're genuinely passionate about, an industry you follow naturally, because then studying the company doesn't feel like homework, it feels like curiosity. And ask yourself this, how do you see the world in 10, 20 years? What problems will still exist? What new behaviors will people have? Which companies are positioned to be essential in that future and bring real value to people's lives? If a company fits that picture and you can explain why, that's probably your company. Now, here's where I'll say something that will make a lot of finance people uncomfortable. Forget the diversify everything advice. Maximum 5 stocks in your portfolio. That's it. Why? Because diversification is for people who don't know what they own. If you have 40 stocks, you can't possibly understand all of them deeply enough to hold them through rough patches with conviction.
You'll panic at the wrong moment, sell at a loss, and then watch it recover without you. When you have 3 to 5 companies you genuinely understand and believe in, you hold differently. Volatility doesn't scare you because you know it's noise, not signal. Concentrated, informed positions beat diversified, anxious ones almost every time for a long-term retail investor. This is where most people destroy years of good decisions in a single week. Do not sell because of a war. Do not sell because the Fed raised rates. Do not sell because someone on TV said recession is coming. Do not sell because your portfolio is down 30%. Actually, when markets crash and everyone is panicking, that's when you buy more. Cheaper units, same monthly investment. You should be excited when prices drop, not terrified. The only legitimate reason to sell is if something fundamental changed about the company itself. The strategy shifted, the leadership went sideways, a competitor made them irrelevant, the product stopped working. Those are company-specific reasons, and those you should pay attention to. Everything else is noise. Macro events, geopolitical fear, market sentiment, these things make headlines. They do not change whether a great business will still be a great business in 2035. So let's recap. Find a company with a real scalable product. Understand it deeply, not just the ticker, the actual business. Believe in its place in the future. Buy a fixed amount every month for 10 years. Maximum 5 positions. Don't sell unless the fundamentals change. That's it. That's the whole strategy. No charts, no timing, no stress. Just a clear thesis on a business you understand, executed consistently over time. The most successful retail investors aren't the ones watching screens all day. They're the ones who have the clarity to pick something real and the discipline to do absolutely nothing while everyone else panicked.